Unlocking value. The impact of earnings per share, EPS, on company valuation and investor attractiveness. Introduction. In the intricate tapestry of financial analysis, one metric stands out as a pivotal indicator of a company's profitability and shareholder value: the earnings per share, EPS. Investors, financial analysts, and market enthusiasts turn their attention to EPS as a compass for evaluating a company's financial health and attractiveness. Delving into the impact of a company's EPS on its valuation and appeal to investors unveils a compelling narrative of financial prowess, growth potential, and market sentiment. The essence of earnings per share, EPS. At its core, earnings per share is a fundamental financial metric that represents the portion of a company's profit allocated to each outstanding share of common stock. Calculated by dividing the company's net income by the total number of shares outstanding, EPS provides a per-share measure of a company's profitability. This seemingly simple ratio, however, carries profound implications for investors seeking to discern a company's ability to generate returns and distribute profits. Valuation dynamics. The impact of a company's EPS on its valuation is profound, shaping perceptions of its financial soundness and growth trajectory. Investors often use EPS as a key input in widely used valuation metrics such as the price-to-earnings (P/E) ratio. A company with robust EPS figures may command a higher P/E ratio, signifying that investors are willing to pay a premium for a share of its earnings. Consider two companies in the same industry, both with a P/E ratio of 20. However, Company A boasts a higher EPS due to efficient cost management, innovative product offerings, or other factors contributing to increased profitability. Investors, recognizing the superior earnings performance of Company A, may view it as a more attractive investment, willing to pay a higher price for each unit of earnings compared to Company B. Growth potential in EPS. EPS not only reflects current profitability but also serves as a bellwether for a company's growth potential. A consistent upward trajectory in EPS suggests that a company is not only profitable but is also expanding its earnings over time. This growth narrative is a magnet for investors seeking opportunities in companies with the potential for capital appreciation. For instance, if Company X has been steadily increasing its EPS over the past several quarters, it signals to investors that the company is on a growth trajectory. Such a scenario can attract investors looking for companies poised for expansion, as a rising EPS often correlates with positive market sentiment and confidence in the company's future prospects. Return on investment and dividend considerations. EPS plays a crucial role in the return on investment (ROI) calculus for investors. When investors assess the attractiveness of a stock, they often consider not only the potential for capital gains but also the prospect of receiving dividends. A company with a healthy EPS is better positioned to distribute dividends to shareholders, enhancing its appeal to income-oriented investors. For example, if Company Y has a substantial EPS and a consistent history of paying dividends, income-focused investors may find it attractive. The company's ability to generate profits and share them with shareholders in the form of dividends can create a steady income stream. Adding a layer of attractiveness beyond capital appreciation potential. Market sentiment and EPS surprises. The release of quarterly or annual earnings reports is a pivotal moment for companies, often leading to significant stock price movements. A key driver of these movements is the variance between actual EPS and consensus estimates. If a company consistently beats earnings expectations, it can signal to investors that the company is adept at managing its operations and outperforming market forecasts. Consider a scenario where Company Z consistently exceeds EPS estimates, indicating strong operational efficiency and perhaps even strategic prowess. Investors, buoyed by the company's ability to outperform, may view it as an attractive investment option, anticipating continued positive surprises and potential upward movements in its stock price. Risks and cautionary considerations. While a high EPS is generally viewed as a positive indicator, investors must exercise caution and consider other factors that may impact a company's financial health. Companies can manipulate earnings through accounting practices or one-time gains, creating a potentially misleading picture of their true profitability. For instance, a company reporting a significant increase in EPS due to the sale of assets or accounting adjustments may not sustain such levels of profitability in the long term. Investors should scrutinize the quality and sustainability of earnings, looking beyond the headline EPS figures to understand the underlying factors driving profitability. Conclusion. In the intricate dance of financial markets, the impact of a company's earnings per share on its valuation and appeal to investors is undeniable. EPS serves as a powerful lens through which investors gauge profitability, growth potential, and market sentiment. As investors navigate the vast landscape of investment opportunities, a keen understanding of the nuances surrounding EPS empowers them to make informed decisions. Identifying companies with not only strong current earnings but also the potential for sustained growth. In the evolving narrative of financial markets, EPS emerges as a key protagonist, shaping the perceptions and choices of investors seeking value, growth, and a solid return on their investment.